Welcome back, and if you've just joined us, you're watching Stock Watch. It's our first show of 2017, and joining me at the desk this evening are Andrew Dittberner from Cannon Asset Managers and Gary Boyson from Randfus. Gents, nice to have you both in the studio. As you probably both know, both MoneyWeb and the Financial Mail run very successful stock pick competitions, and though ours is going to be slightly more informal, in other words, we're going to have to figure out a prize by the end of the year. We'd like to get some 2017 stock picks from our regular guests and also you, our viewers, and we'll keep tabs on the picks and their performances through the year. So if you like, please text and email us your picks this week, and of course your questions, and that's to stock and the question to 33814, or you can email us on stockwatch@bdtv.co.za. Gary, Andrew, we'll get your picks at the end of the program this evening, but Andrew, if I may start with you, we've had a really good start to the year for world markets, and the JSE latterly seems to have picked up a bit. And I spoke about the retail shares earlier this evening. Were you surprised by the performance across the board of the retailers today in particular?
Yeah, I think so. I mean, we've obviously seen a few updates coming out last week that, didn't exactly shoot the lights out. And then we saw, also, I suppose if you look at the Foschini group, those looked okay this morning, I thought. Massmart was also a bit of a mixed bag, but overall I thought it wasn't a bad sales update. But seeing some of those shares up 3-4%, I suppose that it was a bit of a surprise. I don't think the sales updates, even the likes of Woolworths from last week, we saw up quite substantially today to go over 70 Rand a share. And I'm not quite sure if that's warranted on the back of the sales updates we've seen. But yeah, it seems to be, the market's picked up where it left off from last year. We've had quite a strong start to the year. I'm not quite sure what's driving that at the moment. South Africa bucked the trend. I think if you looked what happened in Asia this morning, and then the resources today also set up. So yeah, it seems to be a bit of noise in the market at the moment.
Gary, would you do you think maybe the gains have been made in some of the retail shares this year? So what do you do now? So if you've been maybe late and you thought South African retailers might have had a terrible trading period over Christmas, and it doesn't appear as if that was the case for a couple of them. But if that was your thesis, then you look at the trading updates and the share price performance. Do you jump in now, or is it too late?
Well, I think, again, it very much depends on your time horizon on the trade. So I would have loved to take one of those retailers as my stock pick for the year, but now it's already up 10%. So it's starting to look a little bit pricey. And that one, of course, I'm talking about Woolies. So we looked at the fair value of Woolies. We get to about 80 Rand a share. We think it is trading at a discount. We think it's been punished too hard. We think that the consumer is under pressure. We expected the sales update to be fairly poor, but it was perhaps slightly better than we were expecting. So you get a little bit of a run in the share price. But yeah, I don't think you're getting back to the 100 Rand a share anytime soon. I think the same is true of Foschini. Foschini actually had a fairly good update, I thought, as well this morning. Massmart also not a particularly good update, but slightly ahead of expectations. I thought Massmart would come under more pressure today because out of the whole sort of retail basket, it's one of the ones that are looking a little bit more expensive. But again, I think maybe just a little bit of optimism. Around retail in general, you've got potentially a 25 basis point rate cut this year, if you're listening to the big overseas banks. And you've also got GDP forecast to grow. Our forecast is about 1.4%. So a little bit of growth coming back into the economy, maybe a consumer not under as much pressure, leads people to, I think, feel optimistic, even with fairly poor Christmas updates.
And yet you had the IMF today actually coming out with quite a bearish outlook for the South African economy in 2017. So even though maybe one is feeling a bit more optimistic now, and you talk about growth expectations of over 1%, the IMF expects us to grow only 0.8%. So if their scenario is the one that actually plays out this year, do you buy South African consumer-focused shares?
Look, I don't subscribe to that outlook from the IMF. I think the South African economy could do a lot better than what we expect. If you look at the basket of commodities South Africa exports, the prices have obviously, we know what they've done over the past year. If that can be sustained, I think we could be looking at economic growth, 2% and higher. In that case, the consumer will be in a far better position down the line. And these retailers, specifically the high quality ones, Gary mentioned Woolies, that would be one that we would lean towards as well. If you've got the patience to sit it out, here you're getting an extremely high quality retailer that's got both clothing and a more resilient food division as well. So if you can sit it out, I think at 70 Rand a share, I think it offers a fairly good, or it's fairly attractive for investors. Yeah.
Okay. What about a stock like Cashbuild, which is, you could say it's focused on South African consumers across the board. And there's a question asking, what's the panel's view on the share for the long term? Their performance has been stellar in the light of difficult economic conditions over the last few years. Is it to buy at these levels? Gary.
Yeah, we look at it. I think Cashbuild's an interesting one because we look at it, almost perennially. It constantly ranks very, very well on sort of our quant ranking models, and we'll sort of look at it. Oh, this is a great one to send to clients, but the liquidity is not actually fantastic in the share. So you can't get a huge amount of volume through on a day, which I suppose stops very active trading in it as well. But it has had a lovely pullback, and I think it is speaking to the low income consumer, which a general recovery in commodity prices, like Andrew said, is going to boost GDP. That should be good for broad-based, I suppose, spending habits as well. But also, I suppose it's not just the hard commodity prices as well. It's also soft commodity prices that could feed into a little bit of a consumer recovery. The drought looks like it's coming to an end, and that should feed into profits, perhaps feed into a little bit of job growth as well.
Okay, so you quite like Cashbuild?
I think I like. Yeah, sorry. To go back to Cashbuild, I like the stock. But yeah, it's maybe a little bit difficult sometimes to get in and out of.
Okay. Andrew, do you guys look at it for, I suppose, a longer, Gary, maybe you're more of a trader.
Yeah. It's a fantastic business and it's done exceptionally well. And, we looked at it a year ago and we said, sure, it probably looks a bit expensive. And we wish we had gone into it a year ago. It is illiquid, but for a PA, account, I think it's absolutely fine. And it's the lower, as Gary said, lower LSM focuses on. So it's people renovating their houses as opposed to new builds, and that's really played well into their hands in the rural areas specifically. So they've done exceptionally well.
And I suppose if there's any move on new builds, so maybe any sort of infrastructural push, would you expect Cashbuild then to just be an extra kicker for that?
Yeah, it would probably be an extra kicker. I say probably, but I don't think it'll be a material. It's more, guys going in, buying goods to renovate their house, etc. And it's done exceptionally well, but I think it's, I thought it was expensive a year ago, so I've got to say it's even more expensive today. But in a year's time, I'll probably kick myself. But it's a really fantastic business.
Okay, well maybe the contrarians out there will think, okay, it's fun to add. There's a question saying resources, especially Anglo-American, Glencore, and even Sappi had a good run over the last 12 to 18 months. Are they still good buys, fully priced, or in bubble territory? Gary, if I may start with you.
Yeah, again, I think, if you look at the commodity price outlooks, you've got to look at each almost individual, especially if you're going into the diversified, you've got to see which commodities it's most active in as well. Because I think the commodity story is going to become more and more diverse. With the change in OPEC strategy, I think oil is probably going to, we've shifted our whole target range up, still nowhere near $100 a barrel again, but we're shifting up to about $50 to $70 for 2017. Okay. So a little bit more optimistic on the oil front. Iron ore, we think, is still going to see a huge amount of pressure. We've still got a lot of production coming on in Australia. We're still seeing soft demand in China as well. So, I think from a commodity price story, if you're first trying to predict commodity prices, which is going to be incredibly difficult anyway, I think there could be some pain in some of maybe the base metals as well. That feeding into the actual stocks, I think the stocks have done a lot. They've brought down the gearing on their balance sheets significantly. They've sold off non-core assets. I'm talking about the big diversifieds like Glencore and Anglo-American. They've, in the case of Glencore, they've raised equity capital. They've paid down debt. So I think they're in a far better position than they have been previously from a stock point of view. But again, these are going to be very linked to the commodity prices. So if commodity prices go up, they're probably going to carry on rallying. If commodity prices collapse, they're going to struggle.
And I suppose unrealistic to expect anything near the gains that were made last year. And actually in Traders Corner last week, we were looking at the long-term performance of commodity shares, and they're actually still in a downtrend. They haven't really reversed that.
And that's it. So a commodity super cycle is a very long cycle as well. So again, the big commodity boom that we've seen over the last 10, 15 years has been driven by the infrastructure spending in China. That is going to drop off. Now, people are starting to get a little bit optimistic about Trump putting in infrastructure policies. From the numbers that we've looked at, we can't see, even at his most optimistic fiscal programs, it still cannot take the demand that China has had over the last 10 years. So we can't see that filling the gap. It has to come from India. It has to come from Africa. That's the only place it can come from.
Do you share the same concerns that Gary does?
Yeah, look, I think
commodity
the companies
prices?
are in a lot better shape today than what they were probably 5 years ago. So, you know, through the commodity boom of 2000 through to, call it 2010, 12, you know, these guys were going out management, were going out overpaying for assets, you know, taking on huge amounts of debt, and they didn't really take advantage of that super cycle in the way that they probably could have. Whereas now they're a lot more risk averse. They've sorted that out. They're selling down debt. So the companies, I think, are in a lot better shape today than what they were 5 years ago. So from that perspective, you know, I really like us. Well, we've liked the resource sector for a long time. We still do like it. At spot PEs, if you look what earnings could do, they look attractive.
And is that a cost of books, or do you have any faith?
So generally the diversifieds, so I'm talking Glencore, Anglo's, BHP Billiton, and I suppose you could pick maybe one or two of the precious metal gold companies. But as we know, we are useless at forecasting. You know, we can look at Brexit, you can look at, you know, Trump winning, Leicester winning the Premiership soccer. No one predicted it. So we don't know what they're going to do. If China continues to pull supply back and the demand just keeps ticking over, prices could sustain themselves for you know, the foreseeable future. But, you know, so at the moment, we continue to like resources, in short.
And what about SAPI? Because the viewer did mention SAPI as a paper, as the wood pulp, chemical cellulose. SAPI was a really strong performer last year, and that maybe surprised me. And well, they actually, maybe it was the case that finally their earnings started doing what they should have done, which is every quarter they would improve, because SAPI always used to have one quarter, one step forward, two steps back, and you never really knew where you were. Do you think you know where you are now with SAPI? And do you think the gains that they've made can continue in the year ahead? Andrew, is it a company that you look at?
Yeah, SAPI is not a company I'm particularly familiar with. We haven't held it for a very long time. I do know that they've transformed their business, you know, from the traditional paper to more the cellulose, you know, business. In that space right now, I think Mondi is a better bet. I know that SAPI's done exceptionally well. You've seen Mondi kind of be flat over the past year. I think Mondi have superior assets to the likes of what SAPI has. They have excellent management, they're good capital allocators, and I don't think it's expensive. I don't think SAPI is expensive either. You know, I would lean towards Mondi if we're going to, you know, be in a flat race between the two companies in that sector.
Gary, do you have any preference?
Yeah, again,
no preference?
No. We hold Mondi in portfolios as well, so I do prefer Mondi. Again, Mondi, you know, has had a little bit of trouble in Russia as well. So, but overall, I agree. I think they are better operators. I mean, an incredibly well-run business. I mean, you know, if you look at SAPI, it's. I mean, I think it's as you say. I mean, SAPI is just been so discounted because, you know, people just weren't looking to invest in it because it was performing this enormous turnaround strategy. You know, as you say, moving into chemical cellulose, trying to turn the business around. What you have seen as well is, I mean, SAPI again is fantastic rand hedge stock, and I mean it performed even in the face of a stronger local currency. But what I think. Looking at SAPI, what you've seen as well is you've seen also increasing paper prices. If you look at the actual, you know, the commoditized paper price market, and that would also feed into SAPI. But I think it's the turnaround starting to take hold, and as you say, earnings starting to come through. So yeah, potentially still a little bit higher to go on SAPI, but again, I've got to go with Andrew. I think Mondi is the better play out of the two of them, even though last year SAPI was clearly the clear winner.
Okay, well, we'll leave it there for the moment. If you'd like to send questions and also stock picks for the year to us, you can SMS them to 33814, or you can email stockwatch@BDtv.co.za.